You're absolutely throwing your hard-earned wealth straight into the taxman's incinerator. And the worst part is you're doing it completely legally and voluntarily because you trust a broken system. If you've accumulated over $300,000 inside Australia's largest corporate accounts, you're currently bleeding cash right under your nose this end of financial year. Today, I'll reveal the ultimate 2026 loophole to legally shelter an estimated $120,000 before the looming 30th of June deadline. It's a game changer for high earners. But remember, this is educational information only, does not constitute personal financial, taxation, or legal advice, so always consult a licensed professional before executing major movements. Let's unlock this vault. The wealth game in Australia completely changes once you cross the 45 age bracket with a substantial nest egg. Most executives think their employer handles everything perfectly, but that passivity is exactly what the ATO counts on to maximize revenue. Let's look at the actual mechanics of the 2026 system framework. For the 2025-26 financial year, the standard cap for concessional contributions has been formally indexed up to $30,000. This means you can funnel up to $30,000 before taxes into the system, taxed at a flat rate of just 15% instead of your massive marginal tax bracket. But here's the real multimillionaire secret that nobody talks about. It's the multi-year catch-up provisions. If your total balance was under $500,000 on 30th June of the previous year, you can legally carry forward your unused caps from the last 5 years. This is how we construct the massive $120,000 legal tax shelter before this financial year slams shut. Imagine being able to wipe out a massive portion of your highest income bracket by offsetting it against historically unused caps. It's an unprecedented window of financial optimization. Let's look at a quick example of an executive who ignored this. He left his money sitting exposed in standard accounts without reviewing his historical limits. He ended up paying an extra 45 cents on the dollar for his hard work because he didn't check his MyGov data. Don't let that be your story this season. Whether your capital is held within major industry funds like Australian Super or tied up in conventional retail funds, the rules apply exactly the same way to your asset base. You've got to stop treating your retirement security as a passive side project. The institutional systems love passive investors because they can quietly charge administration overlays while you absorb the full blow of the highest tax brackets. If you don't take control of your concessional contributions history right now, you're essentially leaving a massive cash tip on the table that you'll never see again. It's about executing precise architectural moves on your wealth map before time runs out completely. By utilizing the maximum caps available, you aren't just saving pennies, you're shifting tens of thousands of dollars from the government's ledger directly into your own compounding asset environment. It's the difference between a standard retirement and complete financial sovereignty. Stop right there. Let's take an absolute hard dramatic pause, because this is the exact tipping point where most high earners lose their financial edge. What's your single biggest financial pain or tax frustration right now? Drop a comment below immediately and let me know exactly what's draining your energy this financial year. Now that you've dropped your insights, let's unpack the exact tactical deployment to make this loophole work for you. The core mechanism to accelerate this strategy is establishing a highly optimized salary sacrifice arrangement with your corporate payroll department. This isn't a standard payroll deduction. It's a legally binding pre-tax restructuring of your total compensation package. You're instructing your employer to divert a massive chunk of your gross earnings directly into your chosen fund before individual pay-as-you-go withholding is calculated. But you must move fast because payroll systems require processing time before EOFY. If you delay the paperwork, you'll miss the window entirely. Now, let's address the massive elephant in the room for high earners making over $250,000 in combined income and super benefits. The government enforces a hidden wealth tax known as Division 293 when you cross that $250,000 line. The ATO slaps an extra 15% tax on your concessional contributions. It's a calculated sting designed to penalize successful asset accumulators. But here's the trick. By managing your deductions effectively and understanding how Division 293 calculates your adjusted taxable income, you can minimize the damage or plan your cash flow so you aren't hit with an unexpected debt. Notice later on, most people panic when they get their Division 293 bill because they don't maintain liquid reserves inside their asset structure. You need a proactive approach to cash management to absorb these institutional assessments without disrupting your investment momentum. Now, let's talk about the single most lethal hazard waiting for you in June. It's an institutional failure I call the BPay death trap, and it destroys thousands of retirement strategies every single year. How does it happen? Simple. Wealthy investors wait until the 28th of June or the 29th of June to execute their large lump sum contributions via their online banking portals. They assume that because the money leaves their bank account instantly, the tax deduction is safely locked in. That's a dead wrong assumption that will destroy your deduction. ATO legislation dictates that a contribution is only legally made when it's officially received and cleared by your industry funds or retail funds. If your electronic transfer takes 2 or 3 business days to clear through the interbank network, your capital lands in your fund on the 2nd of July. Boom, your entire strategy is wiped out. Your $120,000 catch-up allocation is completely disallowed for that year, and you've just triggered a massive avoidable tax bill. It's an absolute tragedy caused by simple administrative lag. You must execute your transfers weeks in advance to ensure complete safety. To avoid the BPA death trap, you must bypass the standard automated systems or coordinate directly with your fund managers to verify their specific cutoff times for real-time clearing processing. The system bottlenecks because millions of taxpayers are trying to squeeze through the exact same portal at the exact same minute. When you look at the macro picture, this isn't just about simple compliance or filling out forms before the 30th of June. It's about absolute structural sovereignty over your lifetime wealth generation. By combining the maximum $30,000 annual limit with your accumulated catch-up caps, you're executing a high-powered financial pivot. You're moving massive blocks of capital out of the highly taxed individual realm and placing them under a fortress-like tax-sheltered umbrella. The long-term compounding difference over a 10-year horizon is an estimated hundreds of thousands of dollars in clean, protected growth. Remember, general information only does not constitute personal financial, taxation, or legal advice, so you must audit your own personal thresholds with extreme precision before committing your hard-earned liquid cash to these long-term institutional locks. Don't let the corporate system or administrative lag win the wealth war this year. Take absolute control of your positions across all your accounts right now before the final countdown expires. If this detailed strategic breakdown helped you expose the hidden leaks in your portfolio, make sure you prepare yourself for what's coming. Next, in our upcoming exclusive episode, we're going to completely unmask the hidden fee schedules that retail funds use to quietly siphon off your wealth month after month without your explicit consent. Hit that subscribe button to Aussie Super Secrets right now and stop giving the tax office another single unearned dollar of your money. Disclaimer: the information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.